It's time now for today's strategy session. Stocks and bonds selling off in tandem amid the Moody's credit rating downgrade of the United States. But is this a buy the dip opportunity for both stocks and bonds? Joining us now with more, Jeff Krumpelman, Mariner Wealth Advisors Chief Investment Strategist, also Kathy Jones, Charles Schwab Chief Fixed Income Strategist. Thank you both for being here. Jeff, I want to start with you. This morning, what do you think is the bigger headwind for stocks? The downgrade from Moody's or just the lift that we're seeing in yields?
Well, I think this is kind of news du jour, and our message has been to be balanced. And I think you have kind of a mixed picture out there. And so, yeah, for the longer term, if we don't try and prophesize where yields are going to go, we watch where the trend is, and you can hit certain levels where all of a sudden that becomes a concern for the equity markets. But when I look at the downgrade, the other two rating agencies have downgraded a long time ago. I don't think this is like huge news. And in terms of yields, when we look at leadership in the equity markets, yeah, today the cyclicals are down, but it's really been a reassertion of kind of cyclical leadership. You've seen consumer discretionary, industrials, and the more cyclical areas of the market lead here in this rally. And I think if it's a true headwind, you wouldn't be seeing that. So, I think that after kind of a hard rally and run, you get news like today, a downgrade, yields creeping up a little bit. That's certainly not insurmountable. It's to be expected where you get a little softness in the market today.
Yeah, sounds like you're saying it's a little bit more just exhaustion in that rally. But Kathy, I want to bring you into the conversation because that 30-year at 5%, are you a buyer at those levels?
No, we've been suggesting staying at a benchmark intermediate term duration or a little bit lower because our concern is you have a mix of policy here that it doesn't really hold together very well. It's kind of incoherent. So on the one hand, you have a very fiscally expansive budget, which coming at a time when we already have a large and growing deficit. So that doesn't help on the long end. And then you also have a policy of trying to deglobalize or reduce our trade deficit, which means the dollar pretty much goes down and capital inflows from foreign investors go down. So on the one hand, you're feeding the need for more capital inflows at the same time your policy is discouraging those capital inflows. And so what you see is this tension in the market, and I think it expresses itself in the weaker dollar and higher long-term yields. So we prefer to stay intermediate term or below and stay up in credit quality until all this gets sorted out in one fashion or another.
Yeah, and Jeff, come back into the conversation because Kathy is mentioning sort of the uncertainty in the room that remains with the policy lack of clarity right now. I wonder then, how do you advise clients in terms of positioning? Do you do the Mike Wilson model this morning saying buy the dip? Do you follow the Lori Calvasina model from this morning that there's concern about EPS going forward at these current levels? Which is it?
We're hold your ground. And our theme going into this year was clear air turbulence, where that happens at high altitude, where you get air pockets out of nowhere in blue skies and you fall, and then recover as you get fairly good pilot navigation and you find out that the data is still supportive. So in this environment, it's all about removing portfolio imbalances. Make sure you don't have too much Mag 7, but make sure you have some. Make sure you have international as well as domestic exposure for those reticent to have any international. Make sure that you have some. And then across your sectors, you need defense and you need offense. And so the whole idea is to be balanced, but hold your ground. And I think it's cavalier and premature to say buy in the dips. It's also premature, I think, to say you need to run for the hills. And it depends on what type of investor you are. If you're an aggressive investor, okay, fine. You can buy in the dips. If you found that a 20% correction or close to it freaked you out, maybe this is a time where we've recovered, where your overall allocation to equities was too high to begin with. If you can't withstand that from a psychiatric standpoint, maybe you reduce your exposure. So that's where we are.
So, Jeff, I heard you mentioning tech there. Do you sell or fade into rallies on tech?
So we're neutrally weighted in tech, but more diversified than you would see in the S&P 500. The exposure to Mag 7 makes us nervous the amount. So selectively, we find some very attractive names in tech. Quite frankly, I think the industrials, when we have this need to build out the grid, the power demand that's going to come, there are some exciting opportunities in industrials, and that's where we're overweight at this point in time.
And Kathy, I want to turn to you on foreign demand for U.S. Treasuries. This is something that, of course, is of keen concern given the amount of foreign holders of U.S. debt. Torsten Slok out with a chart this morning indicating that we have seen a little bit of pressure to the downside in terms of foreign buyers of U.S. Treasuries. How much do you weigh that as a potential headwind or a concern for investors in the bond market going forward?
Yeah, I would say this is maybe an imperfect measure of foreign investment demand. This is just in 30-year auctions, which, measuring auction demand it doesn't capture the whole story about foreign investors. So we've had particularly foreign households be particularly interested in U.S. assets, including treasuries. So I'm not too concerned about that in the sense that there's still demand for U.S. Treasuries, and there's no real replacement in the global economy for U.S. Treasuries. My concern, though, is that we're on the margin, we're pushing them away. By trying to reduce our trade deficit in goods and services, we are, by definition, getting less in the way of capital inflow. We're reducing our capital account. And so by doing that at a time when we desperately need to finance this bill that's coming through and a lot of activities, that doesn't cohere. So I'm not worried that they're going to run or stampede out of treasuries, but I think on the margin, what you'll see is demanding higher yields to bring that money in, because now what we're doing is we're cutting off the kind of automatic inflow, and then we have to go out and solicit that inflow, and we have to do it with higher yields.
Yeah, really well said. Thank you so much, both to Jeff Krumpelman of Mariner Wealth Advisors and to Kathy Jones of Charles Schwab. Appreciate you both.